we welcome Mr. A Balasubramanian, CEO, Aditya Birla Sun Life Mutual Fund. Welcome to Grow Money Talk, Bala. So, Bala, what are your tips for new investors? How do they decide on these three main questions? When to invest, how to invest, and where to invest?
So, clearly for a new investor, he is looking at that investing for long term. And also he doesn't know much about the market, he doesn't know much about where to invest, and he also does not get too much of time for him to do analysis. So, that is the assumption I am making. On this assumption, clearly he has to of course look at investing in mutual fund in the form of an SIP, a systemic investment plan, which is nothing but investing in regular interval. That is where I think he should start from his longer term point of view. And as he starts building it, then you will get of course better understanding as to what is his goal and what is the purpose for which he is investing and how long he wants to actually make this investment, and then you will get a more understanding about the other risk involved, and that is the journey I think which comes along the way. I think what is most important for everyone at young age is starting is more important. I think at the time of starting, you once start analyzing too much and then looking at various ifs and buts for taking the decision, and it will be a non-starter. I think what is most important is start investing, and then along the way you keep building up your confidence.
What, according to you, is the right time to invest? People keep talking about this is the right time, markets are good, bad. So, what should be the right time to invest?
Right time, of course, it never comes. As it's said by the famous man in the world, which is Warren Buffett, he always says that timing the market is extremely difficult. Time in the market is actually very important. So, therefore, timing is never, whoever may claim that I am an expert and I know how to invest, and we must assume he is fooling somebody or maybe fooling himself. And therefore, timing the market is very difficult. I think what is most important is actually to stay on course and then stay for long term, and that is something I think one must keep in mind while making investments.
So, as you talked about, systematic investment plan is the right way to begin the journey. So, can you explain something more about systematic investment plan?
See, systematic investment plan is like my mother used to save for us when we were young for our long term education purpose. So, what she used to do? She used to just put every month 500 rupees in recurring deposit of a bank, which earns about 7%. I think if you convert that, a similar concept that in the mutual fund industry is how it can be done. In SIP is actually replaces the recurring investment that normally is done in the fixed deposit. And then SIP is something can be done for many purposes. Everyone at the time of once the child is born, naturally the parents plan for their education first. Second, they plan for their marriage. Then third, they plan for their buying a house. And fourth, they plan for maybe overseas educations, or maybe the fifth they will plan for buying a car and buying a scooter and so on and so forth. Therefore, the many needs of individuals or the longer term needs have to be planned before, because never all these things comes on its own. Therefore, it has to come in the form of savings. Therefore, systematic investment plan, though it looks simple, it is simple, but it can be done for many purposes for which they may need a finance for their future purposes.
So, in the world of mutual funds, what according to you matters the most? Boosting the returns via aggressive stock picking, or protecting the downside from a judicious diversification?
See, both is very difficult. I think when you said the downside has to be protected, is also something which you will never know unless until an accident happens, right? It is the same way that you can never protect it. At the same time, you also cannot predict that so much return I will get. By the end of the day, return only can come only to the extent of the long term capital, what they call it. I think if you are able to borrow at say 11%, you can never actually get to earn more than 3-4% over the borrowing on any investment that you make. And therefore, the return expectation also have to have moderated. But the market as a behavior, I generally call it as a animal behavior which exists in the market. It always comes in every 3 years or 4 year cycles. Therefore, whatever the return that is not being generated in a short period of time, not necessary investment is bad, as long as you stay course of the journey, and then look for some kind of return that could come in the over a period of time where the market suddenly will get bumped up. So, the equity market is always fluctuating, it is never a linear curve. Even the fixed income market in mutual fund schemes also is not as bad as the equity in terms of volatility, but it also is a bit of volatility in the short term. But I think if you stay in the longer term, you do get your return. Therefore, when you make an investment, neither you should make an assumption that return will be fantastic. At the same time, you also need to get so much worried the return will be very bad. I think it has to have moderated expectation that one should keep. I think if your expectation is moderated, and believe me, your experience will always be good. If your expectation is high, there is high probability that you may get disappointed. At the same time, if you have too much of fearful, you may miss the bus.
So we hear a lot of stress on diversification, as you talked about how diversification this thing. If you could share exactly what exactly is diversification from mutual fund parlance, and how do young investors on Groww platform do this diversification in their portfolios?
I think clearly it's important. It's like diversification is like even in the curriculum, if you take there is a language which is your local language, then you have English, then you have a science, then you have mathematics, then you have a commerce and accountancy. So basically it gives you a holistic learning about everything. So diversification is all about having exposure to multiple schemes, and therefore your longer term average return that can come from the diversification is something will give you a better experience. Having said that, you yourself mentioned about when I am young. So when I am young, you ought to make an assumption that you have long years to go. For your retirement, the age of 60. For your ultimate life, the average age about say 70 to 80. So that means when you are young, you have a long innings to play. Therefore, that assumption you have to make. I think I am going to live longer. I am going to make my earnings for longer. So therefore, I need to take that potential risk, which comes actually of investing in equity and investing for long term. So that's something that the youngsters have to do. When go aggressive in terms of building equity portfolio with an expectation of getting multiples of returns is something very important. Is like building a business. But at the same time, diversification comes in 3-4 forms. Any investment needs for any individuals, you always keep money in your savings account. The mutual funds offers a liquid fund for that. You always look for some kind of income, and that's why I think income generating mutual fund schemes are there in the form of fixed income. Then the third objective is actually create a wealth for your longer term needs. That's why I think equity schemes comes in. And finally, as you start earning more and more money, you need to also do your tax planning, and the tax planning also comes in the form of ELSS schemes. Therefore, if you look at the diversification, has to be in the nature of savings in nature, income generation in nature, wealth creation in nature, and tax planning in nature. I think if you keep this a broad principle under which you need to do a diversification, and then naturally you get your asset allocations right, and therefore your longer term goals are also being met, and the returns also will be equally acceptable to everyone.
Bala, we keep hearing about investing in mutual funds, think long term. What is long term? Is this static in definition, or is it product based or a type based, or there is a goal attached to that? So how should a young investor think about long term?
See, long term, of course, everybody keeps asking this question. So what is the definition of long term? So everybody says as per the income tax, greater than 1 year is considered as a long term, just because of it has a tax which is attached to that, which is 10% tax. Earlier it used to be tax free, and that is not the way to look at it. Long term, in my way, has to be looked at that if you go to an organization, you start working in an organization, and then how long you want to work for the organizations. Would you ever plan while working for any organization for 1 year or 2 years, or you actually get inspired by the organization's success and then you want to actually and stay with the organization for long? I think that's the same mindset one has to keep while making investments. And many people actually tend to work in the same organization from the time of the joining till the date of retirement, and that's the same definition has to be kept while making investments also. The longer the time you give, I think you will get a better return. So I jokingly tell to my own team members that hope can always be realized, only give a long rope.
Thank you, Bala. This is a great analogy which you've put it across. Bala, budgets are around the corner, and people have a lot of expectations which come across, and same way mutual funds also, they draw that what is going to come out of the budgets for mutual funds. Can you throw some light on expectation from budget from the mutual fund perspective, and what investors should draw out of budgets while they are investing into mutual funds?
See, budget is actually an every year event, and that comes at times with some kind of surprise. Sometimes, of course, there was no surprise. I think if you look at the last few years, how it has been evolving, and most of the things that used to come in the budget, they are now getting addressed in order to bring in a stability in the most of the policies. Therefore, I would assume this budget may not throw up too much of surprises, both on the positive and negative side. At the same time, there is also an expectation which is getting built up that one has to boost the money in the hands of people in the form of reduction in tax. Therefore, people can spend more or maybe save more. I think that's the expectation which is getting built up. I would also assume in order to boost the economic growth, there is a high probability that Government of India may consider giving more money in the hands of people, either the young age or maybe the middle class population, to address the needs of boosting the consumption by giving more money in the hands of salaried employees.
Great. Thank you, Bala sir. Bala sir, you've spent almost 25 years across seeing this industry. You've also built your portfolios, your investments over these 25 years. How an investor should envisage learning from your investment style in your own personal capacity, and should adapt to building their own portfolios?
Of course, in my case, I had a clear vision that stick to one organization and stay with the organization, and therefore you build your portfolio as well. As I mentioned earlier, that if you are going to actually work in some firm for longer term, that the same way your investment also should reflect in terms of investing. Therefore, I am overweight on equity, given the fact that an equity is something that can give me a very high compounding over a period of time, but if you stay on course. At the same time, you need to also build your portfolio for your retirement point of view. And the PF is something which goes from all our account, and that's why I have chosen my path of investing for retirement through the PF as well as through the gratuity and superannuation that you participate from your pension fund point of view. But significant proportion of money is actually invested between equity and some bit of real estate, but at the same time retirement planning is done through the PF investment. That's the way I have planned my investment. I hope I am right. At the time of retirement, I will realize that.
So, one last key questions for our investors to learn from. What are the 5 key best practices should a young investor follow for their investments going forward?
I think it's very simple. Start early and drive slowly and reach safely. And that comes the similar principle I think you apply for investment. You start your investments early. Don't think too much about it. Second, you keep investing, keep investing. Market will go up and down. Suddenly companies will come and say, oh, you are not making money. Then you will actually get scared. Then, okay, now you will think about redeeming it. Believe me, when you redeem it, you have to come back. There is absolutely no exit on that. It's not permanent exit. Therefore, don't worry about that. And third, just stay on course. These kind of fluctuations, just stay on course. And fourth, whenever you see some kind of uncertainty comes in, do rebalancing of portfolio. Sometimes you may go overweight on equity, obvious, because the sentiments would have been good, but never mind. And then stay with the clear objective of the goal that you have and stay on course. And lastly, keep taking somebody's advice in case you are not able to find the right solution for investment. I think keep this as a principle on an ongoing basis at a continuous interval. I am sure you will get what you have planned for yourself. And finally, I think if you keep looking at your portfolio on a daily basis, and believe me, you will only get high BP or sometimes low BP. Therefore, don't do that, and then keep doing this review at a periodic interval of 3 months or 6 months or a year. And at the same time, keep focusing on your savings and discipline, and finally, you get what you want.
Thank you, Bala, for coming on Grow Money Talk.